So we've got a panel today to talk about venture capital. We've got David Lau-Kee from London Venture Partners, and Shum Singh from Agnitio Capital, and Drew Boortz from Nexon. And I'll give each of them a chance to give a few seconds about where they're coming from, and so we can set context to where they're speaking from on the panel today. So David, do you want to start?
Yeah, I'm David Lau-Kee from London Venture Partners. Actually, before, can I just take a quick straw poll just to understand about the audience here? If you're an indie developer or a games industry kind of early stage company, could you put your hand up? Okay, and out of those with your hands up, could you put your hand down if you don't know about London Venture Partner? So you don't know? I do. You do. Is there anybody doesn't know about us? My job's done, I guess. I can go home. So on that note, what I won't do is I go back and give you a lot of history about London Venture Partners. I think we're quite well known as being very active investors in the games sector, except to say that we are games sector specific. So the only thing we ever invest in is games and the games ecosystem. Rather than talking about the past, let me talk a little bit about the future. We've been reasonably active over the last couple of years, making, I think, 13 investments over the last 2 years. That is accelerating. So through 2016 and 2017, we expect to be doing about twice the number of deals and probably at a ticket size of 2 to 3 times what we've done before. So we are evolving with the market.
Thank you. Shum?
Yeah, I'm Shum. And yeah, no problem. And I founded an investment bank based in London called Agnitio Capital in 2003. We are games focused. And probably what we really try to hone in on is identifying really emerging owner entrepreneurs in Europe and really positioning them for Series A investment through to exiting their businesses to some of the largest publishers worldwide, including companies like his here.
All right, that brings it to me. Good afternoon, everybody. I'm Drew Boortz. I'm the head of Western Biz Dev for Nexon. So it's a bit of a wonder I'm up here on a VC panel, Mark, but I guess we can talk about that in a minute.
You guys have been the most active investors from the strategic side in the world.
Exactly, yeah. And I have to make a confession. I have been in this role for 3 weeks. So if I say something really stupid, I hope you won't hold it against me in future negotiations. But my transition from my old role with Nexon into this new head of biz dev role has coincided with a shift in priorities for us as well, particularly with regard to focusing on Western opportunities, which I think we'll probably get into in a little more detail in a minute, but definitely some interesting changes for Nexon from what we have been doing to what we will be doing over the next 18 months. I was the company lawyer. I was the general counsel. So I'm now a recovering lawyer. I am out of the legal business and fully into biz dev now.
And the nature of Drew's role at the company was well beyond just the lawyer. He was involved in every transaction and was managing many of them. So, and I'm Mark Stevens. I'm a partner at Fenwick and West. Have been in the games space for longer than many of you probably have been alive. I started working with EA in 1983, did about 100 publishing deals for them and a few dozen acquisitions. Most recently, I've been working with some European-based companies, King and Supercell, who've done some transactions recently, as well as companies like Unity, Glue, Nexon, and others. So I think I have got game DNA somewhere in my blood. So let's start with why aren't there more VCs on this panel? David, you're conspicuous by being brave enough to come up here and actually have more deal flow on your own than all of the strategics put together from the last round. So there clearly are deals being done, but where are the other VCs that should be here from Europe?
Yeah, well, you know what? They should be here. I'm glad they're not, that they should be here. But I think one of the reasons they don't come to a conference like this is because it really is for games industry insiders, indies, people who really live and breathe games, and it's about games development. It's not so much of a sort of a financial conference, particularly, even though finance is a big part of it. So I think you'll find a lot of the traditional VCs don't come here because they just don't understand what's going on. And they'll sit and because they haven't got a deep background in the game sector, the games industry, they won't really know what people are talking about. I think it's part of it. There are other conferences where you do get them. They tend not to be games. GDC, of course, huge, gigantic conference in March in San Francisco. But it's a great place for people to be and VCs to be. And the other one in Europe is Slush in Helsinki in November, December time, which started off pretty small. It's not game specific. It's very large now. That attracts huge numbers of VCs internationally because it's fairly broad. But I think, for games sector-specific conferences like this, it's only going to be games sector-specific VCs or somebody with that bent to it, and there aren't many of those around.
I think that's true. So certainly, there are very, very few VCs that are as specifically focused on an industry. It's kind of runs against the portfolio theory of investment management. So. Shum, maybe you can start us with a market overview of what does the venture market look like for games and games-oriented companies in Europe for the last year or two.
Yeah, so I think the past year you've seen probably, actually I'd say about 20 to 30% more deal activity on the institutional VC side. And so when I define institutional VC, I'm specifically referring to really financial VCs coming in, strategic investors, and you're really looking at deals that have been publicly disclosed, and really to the tune of sort of 2-3 million euros and above that have been invested in most of these studios, service providers, UA specialists, etc. And I think the interesting transition, probably 24 months to the last 12 months, has been a lot more money being allocated towards service providers. And I say this again with respect to institutional rounds. I think on the early stage VC side, David can obviously speak a lot more accurately, and I'm sure that I believe you guys have done significantly more deals in the last year than you did even prior to that. So I think it's harder to track really on the early stage side, but at least you are seeing, just in sheer absolute numbers, more deal activity in the last 12 months versus the previous 12 months.
And I've seen the chart that you have, which lists about 30 or so announced transactions in Europe. Of those, though, there's a significant skew to the smaller transaction size in the 1 to 3 million euro range, as opposed to the 10 plus million. Is that also a repetition of the prior year, or is that fewer larger transactions happening?
I think generally speaking, certainly in the game space in general in Europe, you don't have that many investments really north of 5 million in Europe. They tend to be fewer and far between. I think once a studio or a business can really establish itself as a market leader, then it generates much more significant VC interest. And then actually you'll see multiple VCs collaborating and actually syndicating out deals. But usually they tend to be fewer and far between.
If I can just add to that, I read a statistic this morning talked about, this is about the mobile sector generally, so not specifically games, but the mobile sector generally. 2015 was the biggest year on record for exits, something like $101 billion, and the biggest on record for investment, $69 billion. Now that is across the mobile sector generally, not just the mobile game sector, but I think that similar things are kind of happening there. One note of caution here is that in the last quarter, that number tailed off significantly. So there are people who are calling peak mobile games investment. And certainly, I think going forward, and different people will have different propositions, of course, but certainly our investment thesis going forward is changing quite substantially. So there are companies that we would have funded 2 years ago or even a year ago that we probably won't fund this year or next year.
So let's actually capture that a little bit. That you're, as a games-focused fund, are substantially changing your focus for investment targets. Is that no more mobile, now on to new platforms? What is it that's driving that?
Okay, so the central thing here, and I'm sure it's a theme we'll come back to eventually, is that a lot of our investments in the past have been in mobile free-to-play studios and developers. And that has proved to be incredibly valuable for us and great for the sector generally. But we're facing now a real crunch on LTV CPI arbitrage. All right, so it's increasingly difficult now as a small mobile free-to-play studio to get the type of visibility in terms of user acquisition that means that you're going to be on the right path for growth. To your point, does that mean that we're not investing in those sorts of companies anymore? Absolutely not. What it does mean is that we're looking at slightly different makeup. So, it's not sufficient that a games company comes to us and says, here's a fantastic core mechanic, here's a great engagement mechanic, this works really well for monetization. Yeah, we take those things for granted. But tell me what you're going to do to make sure that you are bringing down your eCPI. What is it that's special about what you're doing? And that could be about social engagement or other ways to increase the K factor. It could be about using different channels. It could be traditional outreach, those sorts of things. But we're looking, if it's a traditional mobile company, free-to-play, for them to have that side to it. And a corollary to that, of course, is that we're also now looking afresh at premium content and premium products, whether that's just premium straight or it's subscription-based. But looking at different ways of people sort of handling this LTV eCPI crunch that exists. That's part of it. The other part of what we're thinking and what we're looking at is that there's, I think, a maturation that's happened in the game sector. And we see a lot of startup studios which actually probably aren't even right for us as an early stage VC, because it's clear that they are a studio first, foremost, and always, rather than a growth company first, foremost, and always. And it's a bit of a subtle distinction. But as an early stage VC, we need to see the possibility that whoever we invest in can be worth 100, 200 times the valuations we start with. And that doesn't mean it's guaranteed, of course, we don't expect it, but we have to see a route or a path to that, both in terms of what they're doing and, more importantly, in terms of what the principals want to achieve with their company. And if they don't have that, then they don't necessarily fit into our investment thesis going forward. They'd be better off being a part of a larger organization, perhaps.
Well, speaking to a larger organization, Drew, isn't that an opportunity for Nexon to be able to step in, either to back up the marketing spend that's required to be relevant in the marketplace for a company that David already has in his portfolio, or to work with somebody that may not be a 100x return for the venture world? How does that mapping work for you, and what are you looking for in your deal flow?
Yes, the answer is yes. That is an opportunity for us, and it is one that we take seriously. We get the benefit of being able to look for some slightly different factors when we evaluate these kinds of opportunities, and that can be good and bad. We're fond of saying that we're not interested in one-night stand opportunities. We are looking at the investments we make as a strategic partner as getting married. This is not, while it may start as a one-game deal, we view these relationships as being 5, 7, maybe 10 years in length. It may encompass multiple games, it may not, but with games as a service, we're thinking even one game might go that long. So we are not necessarily as interested in seeing a company that will absolutely have a guaranteed X multiple by the time we need our money back. We're more interested in looking at, can they make great games over the long haul, and are they willing to work with us as a strategic partner? And this is where the negative side kind of comes in when we end up getting involved in opportunities that had an early stage VC. Sometimes they are very much focused on what that exit looks like. And whether that exit is with us or with someone else, it makes it harder for us to do our job as the strategic because of that view of this is not a one-game opportunity.
So, David, you made a comment earlier when we were chatting that the Supercell experience was kind of the quintessential venture path. If you could kind of lay that out a little bit for the audience, so we all know what that looks like, and also, is that still possible, or is that now the stuff of legend that companies used to be able to do this but now can't?
So to your last question first, I think it is possible still, and certainly there are some opportunities we're looking at where that's not out of the realms of possibilities that will be a similar trajectory, so it can happen. But Supercell, I think, is really interesting, kind of as a poster boy for the sector and the industry in terms of the company itself, what it was doing, how it grew, how it developed, and the success it had. But it's also, and perhaps it's sort of less obvious to people, it's actually a fantastic example of the cadence of fundraising, how you do it, when you do it, the amount you get in, that takes a company to that level of success. So Supercell, everybody knows the high-level story. Here's a company that was founded in May 2010, and within 5 years was valued at somewhere between 5 and 10 billion. So it came from nothing to that scale. It went through a number of fundraising events. So to detail those, the first fundraising event was when it raised 750,000 euros as a seed round from London Venture Partners, from Initial Capital and a few others. So we got in very, very early. We don't disclose that valuation, but you can make educated guesses about what that might have been, with 750,000 going in very early on. 6 months later, and when we invested, by the way, they didn't have a game. They had some ideas for a game. And they had a production methodology, and they had a vision, and huge experience.
And a pretty damn good team. I mean,
Great,
it was all about the team in that case.
Yeah, hugely good team, fantastically talented team from Digital Chocolate. And we invested on the basis that because we'd been in the game sector for the previous 20 years, we could recognize what great talent looked like and great capability. So we got in at that stage. So for us, bizarrely, even though it was very early and that was a seed stage round, I feel that actually we were taking less risk than the next guys that came in, which was Accel. Accel came in 6 months later, put $12 million into it at a valuation of $53 million. So again, you can see with only 6 months what huge increase in value. And the reason I think that that's interesting is Accel's a very traditional venture capitalist who does fairly large rounds. 12 million was quite a big Series A round, but it worked for them. The reason I think that they were really, really smart is because Supercell still didn't have a game. What they had was their first game, Gunshine, in beta. Gunshine was kind of okay, but it was a learning experience on Facebook, and that was it. So Accel, I think, very, very smart as a traditional VC without game sector specific background, getting in there and doing it at that level. And then a year later, they raised $130 million from IVP, from Atomico, and so on. But it's really important to stage the investment. So we had the seed stage where we got in at 750,000 euros, a Series A stage, $12 million from a traditional venture capital, and that was to help sort of expand their operations and really get to grips with delivering products and service. When IVP and Atomico came in with $130 million at a valuation of, I've seen it reported, so all this information is reported information rather than inside information, at $770 million, and that was a year afterwards. But that money was not there to fund operations. That was a secondary. So that actually was to buy down existing investors. All right, so Supercell itself never even used the $12 million that it raised at its Series A, and yet still went through and did a Series B secondary deal down the line. And then, a year later, a year and a half later, sold out 51% to SoftBank, which I think people know about. And a year after that, a total exit to SoftBank at somewhere between $5 and $10 billion. So that, from a venture capitalist perspective, that's beautiful. It's a very nice cadence of development that shows where the value's been generated at each stage and what each of the investors was bringing to the party at the different financing rounds. And of course, for Ilka and Mika and the guys at Supercell, again, fantastically well executed from their perspective as well.
It also gives you an idea of you need to be very disciplined not to have seller's regret, because each deal within a month or two after the closing looked like it had been done at an incredible bargain price. I mean, you have the valuation at the round also, unfortunately, we have too many insiders up here who actually know the real numbers. So if you assume that the valuation on the real round was well south of the 52 million that Accel came in at, and the Accel deal was 6 months later, there were probably conversations with Accel that were happening 2 or 3 months after the closing of that round at a significant step up. And so the insiders are looking at having just taken dilution at, for a relatively small amount of money and for a significant stake in the company. And I think it's important as a founder to have the discipline to say that was then, that allowed us to get to this stage. And I think in this case we had founders who were perfectly capable of taking the longer view. But in each case, even at the $770 million, if that was the valuation for the IVP and Atomico deal, within not very long, it became clear that was as Clash continued to climb the charts, as was Heyday, it became clear that was itself a bargain transaction. So the dynamics are interesting when you have a company at that pace. That's kind of a classic Silicon Valley story. And there's a lot of companies outside of games who have that kind of ramp, but there aren't that many inside of the games space, and certainly not that many in the European market that are growing at that kind of pace and that kind of cadence. If you were to do, Shum, if you're working with companies or investors, is 5 years the right kind of time frame to notionally think about to get from start to multi-billion-dollar valuation?
I mean, that's a fantastic example, and I think what David alluded to is incredibly rare. Let's all be honest here. So I think the vast majority of people in this audience are probably thinking, well, how do I attract investment, and how do I get investment from an investor, whether it's financial or strategic, that's going to ultimately help me accelerate my business and accelerate different functions that might be lacking that they could add value to. So again, I think there's advantages that a purely financial investor can bring to the table, but then there's also a significant amount of advantages that a strategic such as Nexon could bring to the table. What I would say is, despite that Q4's numbers indicating that deal activity and investment into the sector has been down, there is still a tremendous amount of money, not only from, I would say actually, probably not from traditional venture European capitalists, but certainly from a lot of strategic investors from Asia, from Korea, from Japan, from China, that are eagerly looking at investing in various different European games companies. And so a number of the companies that we're currently advising are certainly deep in discussions with those strategic players.
So I want to get into the role of strategics with a venture-backed company, but before we leave the venture side, one of the things that I'm seeing, and this is certainly on the U.S. investor side, is that the dial between greed and fear has not quite pegged on the fear side, but it's getting close, which is causing non-economic behavior from the side of from the venture side of the table. Are we going to see that in 2016? Are you seeing that now?
I mean, again, I think it really depends on the size of your studio, and obviously, I think everybody's kind of mentioned there's certainly a flight to quality as the industry has matured. So, unless you can really present yourself having a, obviously phenomenal team, track record, previous experience, and ideally exiting previous businesses, you have all the requisite skills or criteria that an investor is looking for. Well, I definitely think that there's tremendous opportunities out there. There's loads of money out there, especially from Asia. I just think it's about packaging. It's about really honing in on and understanding your vision and your mission and how you're going to present that to the appropriate investor. So despite all the doom and gloom, I still think that there are great studios out there, even in Europe.
Just to that point, I think you're quite right, but there's accidental successes and there's purposeful successes, and I think that the era of accidental successes is if not over, rapidly closing. So now success at that level is very purposeful, which means that you need to have that fantastic team that knows what it's doing.
And I think I want to echo one of the points that you made earlier about it's not about being a great studio, it's about being a great growth company. to be attractive to a venture capitalist. And I think that that's a distinction that it's easy to hear that and kind of let that wash over you and not really understand the difference. But if your focus is on creating great games, that may not be sufficient to attract the financial interest of a venture capitalist. You need to also have and I'm going to make a shitload of money doing it. And here's how I'm going to do it, and here's how my ratio between cost to acquire and lifetime value and so on is going to be relevant. And I think that is an aspect to leadership inside of a studio or game organization that is easily recognized from the investment side of the table.
Just that point, that's huge. I mean, we spend as much time talking with prospects and trying to persuade them why they shouldn't be taking venture capital as we do persuade them to take venture capital, just because we just know it's not right for them. And again, it's partially altruistic, I guess, because we've been there, we've done it, we've run studios. I've run a studio, built a studio from scratch, and a tech company from scratch. So I know what it's about to have passion for what you're doing, that sometimes is separate from the economic or the money-making side of things. And so, we'll often get people coming to us with a really great studio who, can do some fantastic things. But the worst thing in the world for them would be to take venture backing, because then it comes with certain expectations. And it might not suit everybody. And if it doesn't suit everybody, then it's incumbent on us to let them know that, not to take venture capital, but to look for a different source of finance.
Sometimes when they say it's us, not you, they mean it's you. But sometimes when they say it's us, not you, they really do mean it's us. That is, the match of what they want their money to do is not a good match for the business that they're talking to. So I think that there's an important communication there to listen to.
I think it sometimes goes unnoticed that it works from my world as well, right? Sometimes it is the strategic saying, strategics are not right for you and your company, given what you want. I think those are probably a little more rare than what my colleagues on the panel here might experience, but we see that as well for the inverse reasons that have been brought up thus far.
If you want to run a great farm and create great produce, then working with strategic makes a lot of sense, because that's the business they're in. A farm may not be a high enough growth entity or high profit entity enough to be a venture investment. So there clearly is overlap in terms of what's interesting, but it's not, the Venn diagram only has a relatively small portion of overlap, and there's a lot in the circles that don't overlap. Speaking of that overlap, so Drew, when you're looking for a company, a couple of things. One, on the prior panel, your peers at NCSoft and GREE talked about looking at 180, 200 deals and doing one per year. Is that representative for you? Does that ring true in terms of the number of companies that you take a close look at and either decide to invest in or not?
Considering that most of the previous panel is in the room right now, I think I should say yes.
A little controversy would be good.
Right. Well, as I mentioned earlier, I've been on this job a grand total of 3 weeks. I can give you those numbers. In the 3 weeks that I've been doing this, we've evaluated, I would say, something between 20 and 25 opportunities. So I think to your point about the fear-greed index starting to swing more towards fear, I think it has seen something of an uptick for people running to strategics as more of a check-in option. Hey, we're out here, would you be interested? Whereas we didn't get as many of those calls 6 months ago. Everyone was running to VCs. But I think that cadence is probably about right, and probably what 2016 will shake out to be.
So that's on the order of more than one per day.
Yeah.
Which is, and by a look, what does it look like from the other side? If you're one of those 25 companies, what does that interaction look like, and how do they know that they've been looked at in past? Is it a long no? Is it a short no? Is it what's the courtship look like?
I want to make sure that we, as Nexon, are better about our feedback in opportunities than we have been in the past. I think that we have something of a reputation for some very long no's, or sometimes not even a no, just sort of a, oh, you're still here? Okay. Shum's laughing.
I know your colleagues very well.
Who are fantastic people.
Absolutely.
Yes.
Absolutely.
But
Sometimes it's good to get an answer from them, though.
that's right, and that's part of the reason why I'm now leading Western Biz Dev, is because when you have some of those cultural aspects coming from Asia, trying to get to a quick no, because most of the things we see are going to be no's, and most of those should be quick. It's not. That can be challenging, or perhaps I should say that can be very difficult. When you have that kind of cultural tension there. So to put a fine point on your questions, of those 20 to 25 that we've seen in the last 3 weeks, the vast majority of those have been quick no's, where within 24 to 48 hours, we've gone back and said, thank you for contacting us. We're not the right partner for you at this time. Feel free to check in with us at a later date. We've got 3 or 4 that we are evaluating strongly. Of those 3 or 4, I would say 1 we are evaluating very strongly at the moment.
And just to ask that same question of the venture side, because the number of people who think they're talking to you is usually actually much greater than the numbers that you think are talking to you. So what does that look like from either side?
Listen, my aspiration is that we will be much better at sort of that outreach to people who are connecting to us. The thing is that we are, unfortunately, inundated. I mean, we saw something like 500 plus proposals last year. So, and there's 3 of us. So it's difficult to be spending a huge amount of time on all of them. What we do though is when the ones that we tend not to get back to quickly or at all are ones where it's clearly inappropriate. You know, it's not our sector, it's not our field directly, or they haven't looked at our website, which gives a ton of information about exactly what we like to see, and gives lots and lots of hints about how people should approach us and where they should approach us. When people clearly haven't bothered to do their homework and look at it, it's difficult for us to get excited about giving them a lot of fantastic feedback. When people have done that, and we engage with them, we'll often give far more feedback than is sensible. You know, we'll often spend a lot of time with them, sort of brainstorming their strategy and helping them out and so on, without knowing whether it's a fit for us or not. But just because that's a fun thing for us to be doing, and we're creating a vibrant ecosystem where everybody benefits, and ultimately we think we're the best sector-specific VC, and ultimately we're going to do the best out of that.
It elevates the industry.
Absolutely.
When you do that, and that we find ourselves doing that quite a bit as well, where we'll be giving significant feedback and we're engaging with someone who we've already told this isn't the right fit for us, but we want to help you crystallize what you are selling, so that when you go to the Nexons of the world next, or when you go to the VCs, that your vision will be much more salient and much more easily communicated, as opposed to, we have resumes and thoughts. Can you give us money?
So I am one of the ones who gets the other phone call, which is from the team saying, we're having a great conversation with David. He told us no, but he's engaging with us. He must really, really like us. I think there's a yes in there somewhere, and we just need to get over the following 3 objections. So you need to listen to the no, and if they are willing to give of time, which they oftentimes are for the purpose of, because they're good people, because the industry is benefited by it, et cetera, take all the value that you can, but don't think that means that the date who said I don't want another one really does want another date. It probably won't happen, and it is a negative feedback loop for them, which discourages them from actually engaging with companies if the ones they engage with think that there's messaging there that's not being said. Shum, is this a process that where as an advisor you're helping the teams through this, how to interpret, how to approach, et cetera?
Yeah, absolutely. Particularly when it comes to overseas investors that they might not know well, or particularly if it's studios that have a certain skill sets, but maybe are lacking a certain amount of commercial acumen. But again, as I think we've all been saying, the filtering process, even for ourselves, is incredibly selective now. just because of the amount of time that we spend with VCs and strategics and hearing directly from them what they're looking for. So, there is a pretty high bar, and I mean, that just keeps rising. So, often you know the obstacles and the hurdles you're going to face when you're talking to both sets of potential investors. So you want to ultimately work with individuals or really teams who appreciate and acknowledge, and ideally who've been through it previously.
The prior experience is very important.
Indeed.
So Drew, is there room in a cap table at a company for both a strategic investor like yourself as well as a venture voice like David? How does that work?
Yes, I think there is, but not nearly as much room as you might imagine. I think that we are at a point now where the two camps of VCs and strategics want fundamentally different things. Certainly Nexon as a strategic wants fundamentally different things from a VC. We find it helpful to engage with companies that may have taken on some very early seed money, as Shum points out, to help with some of that business acumen. So we don't feel like we have to coach them on everything as part of this process. But then there's a very finite spectrum of between that early stage company that may have taken a small seed round to help them get up and running, but still wants the strategic and wants what the strategic wants, to then going down the more traditional VC path of now we've done an A, maybe we've even done a B, now we want to start talking to a strategic. We find that to be a very difficult fit for us to play the role as a strategic, and we are not a VC. We are not the best equipped company to help you out with later financing stages without having that strategic element layered on top of it.
David, what does it feel like from your side?
You know what? I think the picture's changed a little bit. If I wind back 2 years, 3 years, there was, I think, very little overlap, very little chance for both existing on the same cap table. Because primarily, and again, previously in the game sector, as everybody knows, that if you were a developer, you were at the bottom of the value chain, and essentially that you were beholden to publishers and distributors and owners.
The good old days, you mean?
The good old days,
yeah.
and hey, I was there. I experienced it as a developer, and so when mobile games really started taking off, it was a fantastic revelation that there's this democratization in terms of development, that anybody could develop very cheaply, very easily, and more than that, anybody could distribute really easily with a couple of pushes of buttons. Suddenly, the product could be distributed, and so there was a real question about whether you needed strategics there to help you with the biz dev or the publishing or whatever when you could do it yourself. As I say, the world has changed. It's now longer so simple to do that. Well, you can do it, but you're just not going to get heard above the noise. And the sophistication that's necessary in terms of your business operations is now so great that actually there's a huge amount of value that a strategic can bring, because that's their business. So I actually think there's more room now for coexistence than before. What I will say, and you're quite right, I mean, VCs and strategics sometimes want fundamentally different things in their straight investments. Not always. I think things can be staged, as we talked about. But sometimes they can be fundamentally different. And so for a strategic, sometimes it's I want to put money in it, and it's the beginning of a courtship leading to a marriage. And the difficulty with that for a pure financial investor is that I don't know who else is out there. Why do I want to
nobody.
Pick from? Why do I want to
There's nobody.
Pick from a room of these 3 or 4 guys or girls when there's a whole world out there potentially that I could get married to sometime down the line. So that tension always exists. But when there's no tension, then there's no interest. I mean that's not a bad thing to exist.
And that can be reconciled, but it's for the people on the company side, you do have to, if you have a venture cadre of investors and a strategic investor at the table, you are definitely playing to each of their needs, fears, et cetera, and the terms. You're oftentimes caught in the middle. because you may be aligned sometimes with the strategic, and you may be aligned other times with the VC, and understanding what each of them wants and helping to manage them and having them not come into irreconcilable conflicts, which does happen, is critically important.
Yeah, I mean, I would add that I think that if you're a more earlier stage games business and perhaps you're lacking certain of the criteria that someone like David or LVP or other early stage VCs are looking for, and maybe it's questionable in terms of that growth type approach that you're focusing on, but there's inherent tremendous game development skills and talent, but perhaps lacking UA understanding, perhaps lacking some commercial game design skills, perhaps lacking some business intelligence. So that kind of marriage is much more suitable with a strategic investor. So I think that also perhaps a lot of the studios that inherently would find their way, that LVP would find attractive, would probably not be the ones that Nexon would find attractive. Or other strategics for that matter, because of the different requisite skill sets, perhaps.
Just to sort of add to that point, because again, I think there's a misconception that LVP as a venture capitalist is somehow beyond the very early stage, and that's not the case. We have invested last year in one guy with an idea, and that's where it came from. So we actually want very, very, very early stage, but what we want, as you point out, is a rounded view of what that business will be. So you need to have the commercial side of it, or a way to get that commercial side of it, or an easy path to that as well. But otherwise, we like to see things very, very early. And in fact, there are deals that we've seen where there have been some investors in there before us, very early, some angel investors, and we'd love to do a deal with these guys later down the line, but we can't. And we can't because the cap table is messed up, and there are other rights and restrictions in there, which means that we know that later stage, it's going to be difficult for them to raise the money they need to get. So what I would say is it's never too early if you have the right proposition, and if it is the right proposition, then get to us as early as you can.
And you probably know as a team in your heart of hearts whether or not you do have the full rounded proposition. Because if you're talking about the next 5 years of the game development, how to finance it, how to launch it, and you've got all of the bases covered, and among the team members there's a been there, done that, then you may well be well-rounded enough to have a early stage conversation with a venture capitalist. But if you're kind of faking it on one or more of the key elements because you were a producer at a larger organization and you never really ran the marketing side, you don't understand the economics, or knew it from afar but weren't turning the crank on the marketing, or otherwise are missing some key elements which you probably know that you're missing. That's really what we're talking about. Is that may not be the right team to make the first call to the venture side.
But just on that as well, and just a shout out for I don't know if people have heard about Play Hubs, which is a co-working space set up in the UK and London that's been underwritten by the LVP partners as individuals, and by Chris Lee, who's in the audience there as well, who's a well-known angel investor. And we created this co-working space to specifically address this problem where we had great creative, great technical, but perhaps lacking the commercial expertise. And we thought that after seeing how it's worked in Helsinki, where there's a tremendous amount of information that's shared about the commercial side of things, which has a benefit to everybody, it's like, how could we take that model of cooperation and duplicate it elsewhere? So PlayHubs is an example of a co-working space where people come in who aren't necessarily ready for the first stage of investment, but with a small amount of time and lots of sort of help from others around, can get there.
And also just to comment, the other source, although there can be cap table issues, the angels who have been there and done that can be incredibly helpful for a team. They can recognize the talent and will have a higher toleration for missing elements on a team because they know they can help provide that or can help coach the team through. So there are different teams have different natural partners in the financing cycle. So changing it up a little bit, venture capital is, well, let's see, I think one term is there's a theme that's often important to venture capitalists. The other perspective of that is the lemming effect of the venture world behind particular areas. comment, if you could, each of you on your view of VR and AR. And actually, if you could break it up between the two, that would be useful, because usually they're thrown together and they're very, very different propositions. And let's start with that.
Who wants to take that one first?
Okay.
Drew?
I will once again be the contrarian voice and say we don't care. And I mean that in the, we don't care that it's AR or VR. We are not a platform-specific focus at the moment. What we are focused on is finding and building and cultivating great games on whatever platform they exist. If you come to me with, hey, we've got this great idea for VR, we will listen to that. If VR is the right platform, then we will go down that road with you. VR may be the right platform, it may not be. But if you don't have a great game, we're not going to be interested in it just because it's VR.
I would say personally, I don't specifically have a view on either platform. What I would say is that until I think, I mean, there's been tremendous amount of fundraisings and money being thrown at studios and companies everywhere. I think until there's really a commercially viable market, are you really going to start to see, I think, a lot more interest from different sets of investors. There's a tremendous amount of hype, so a lot of these companies will fall flat on their face. That I'm 100% convinced. So at the moment, every strategic and certainly financial investor I speak to is still pretty much focused on mobile free-to-play.
Yeah, I mean, VR is, I mean, it's the biggest $0 billion market that exists right now. You know, tremendous amounts of interest behind it, without proven customer base and business models. But you know, I don't want that you to interpret that as, you know, being hugely negative about VR. I'm slightly, but only because, you know, I first got involved in VR 25 years ago, and have been through the succession of it's going to be big, and it hasn't yet happened. I think it's better placed now than it ever was before, and so it's exciting from that perspective. But from a venture capital perspective, certainly we have not made any VR or AR investments. There is one that I wish we'd done. And the reason that was interesting to me is because it was much less about the content and much more about the grammar, if you like, or the infrastructure, so enabling VR content. And that's interesting because that often presages the content itself, you know, and so as a venture capitalist, we want to be investing not where the market is now, but looking at a trajectory and saying, how can we intercept it in 2 years' time? And I think even 2 years' time is too early for VR and AR games content. I think there will be lots of scope for other sectors that will do very well, particularly in AR, rather than the game sector in the next 2 to 3 years. But I think games, really, from my perspective, I'm looking 4 to 5 years before it becomes, you know, substantially enough to be really interesting for the content side of it. So now my interest is there, but it's much more on technology. It's on production process. It's on the grammar. It's on those sorts of things that presage a viable active content market.
You also have a number of VCs who already have a bet or two. If they're going to bet on a VR studio, they probably have already laid that bet down. I'm not sure there's room for more experimentation within the portfolio management that VCs run. That doesn't mean there won't be more deals, but certainly the exciting companies in VR that I'm seeing are the ones, you know, it's companies like Unity that will have a big role in VR, but have a real business otherwise, and will be there when it comes, or Jaunt, which is not in the game space at all. I mean, there's a number of interesting things in VR that aren't yet for games content. eSports.
eSports, we were talking earlier about eSports, and everyone in this room will know about it, but outside of people within the specific game sector, people have no idea what eSports is, and it kind of reminds me of the year or two before mobile games happened. We kind of knew they're happening. We'd seen the full start with weapon and feature phone games, and we saw what people were doing on full smartphones and how great and how big that was going to be. But we were within the sector. People outside of games didn't see it, and I see the same thing with eSports. I see huge amounts going on in eSports generally, from the technology, from the infrastructure, from 1,001 different perspectives, as well as the content perspective. And I find that a very, very exciting area going forward, because I don't believe that outside of the game sector, people really understand how huge it's becoming.
Drew, do you have a play in esports?
In the West, not at the moment. We have a huge presence in esports in Korea. We have the Nexon Arena. It is a dedicated space for esports that doubles as a bar and cultural center when it's not being used for esports tournaments. They show nightly runs of not just Nexon games, but of League of Legends, of Hearthstone, of a handful of other, StarCraft 2, how could I forget that? Where people will come in and buy tickets for matches that have already happened. They're re-showing it like Rocky Horror Picture, and people are commenting because they know what's coming on. It is a much more mature market and opportunity in Korea and really throughout most of Asia than it is here in the West. And there is a ton of opportunity in the West within the world of esports.
I think particularly with many of the Asian publishers who do have much more exposure to what advanced esports look like. It's not just Korea, although Korea I think is way further advanced than any other marketplace on this. StarCraft was happening 10, 15 years ago as a major cultural event in Korea. So, Shum, are you seeing the same? Any comments on specifics?
I mean, I've actually been to the Nexon Arena, so I've actually seen it live. Yeah, I mean, I definitely, I think compared to VR, AR, I think that there's a lot more exciting opportunities in esports. I mean, you certainly are seeing a lot of companies making bigger bets there. And a lot of the bigger publishers, whether it's Activision, EA, et cetera, in the West, are certainly now announcing dedicated divisions to really capture this potentially, very, very lucrative market.
And it's broader than just game companies, right? You have insurance companies sponsoring esports teams now. You've got whole ecosystems of opportunity that are being generated with esports that are not mainstream and yet incredibly lucrative.
And fantasy esports, and there's all kinds of extensions of it that you can see. We have a few minutes left, and happy to take questions from the audience.
I've heard a couple times yesterday and today that claiming that your game is going to sort of topple Candy Crush or Clash of Clans is sort of silly, because you're never actually going to be able to outspend those companies and sort of claim the top spot on the chart. So if we assume that's correct, as VC investors, what do you think of as realistic for purposeful success, or what's the definition now, a realistic definition of making a shit ton of money while we do this, knowing them?
I think the difficulty here is that you can't come up with a better Clash of Clans and hope to be successful, even if the game is, in some creative or gameplay way better. It's not going to work because of the install base that exists, because things like Clash is not a game. Clash is a hobby, right? And that's my hobby, that's the team I support. And you're going to come up with a different one, so it's just not going to work. I think that what matters now is how are you going to innovate? How are you going to be different? So show me a different mechanic, show me a different way of thinking about it. And most importantly, as I alluded to before, show me how you're going to essentially affect eCPI in a really meaningful fashion. What are you doing that's going to be different there? Because now, if you do that, you're sidestepping the whole LTV CPI arbitrage issue. You're no longer up against the big spenders like Supercell, and more importantly, people like Machine Zone, who will spend aggressively to acquire users because they want them and want for you not to have them. You cannot compete against that as a small startup studio. So find a different way of doing it.
When you talk about those giants, a lot of times they're spending defensively. They're trying to keep those players, or perhaps another way to look at it is prevent you from getting them, which sounds sadistic. It's not really, but it's strange.
You're right. A share of voice, I think, is the euphemism.
Yes, you are correct that trying to outspend those guys is a sucker's bet. For our objectives, if we look at a game and say, we think this is easily top 100 or top 50 material and top 1 or 2 in its category, that is an investment that we love. And that's one that we will make all day long. If we can get it into the top 25, that is a smashing success.
And it's much more likely that a strategic partner would be willing to bankroll the launch of that than the venture world is ever going to be spending for the marketing spend, unless the economics are absolutely locked. And even then, raising equity dollars through the venture world to get that kind of marketing budget is I think, a fool's game.
David mentioned earlier on, very briefly, kind of forward thinking, that the potentially premium subscription content might be an interesting take on how to battle LTV crunch. There could be problems there. I'm just wondering if the panel could maybe provide some more thoughts on what that might look like.
It is what it says on the tin. It's a way to sidestep the LTV crunch through premium product. That might be premium product on existing app stores, or it might be different ones. And and again, 2 years ago we wouldn't have been that interested in PC or console. Now we're becoming more interested potentially. Steam is very interesting to us. So I think it could well be that the type of content that gets distributed in that fashion may well be premium or subscription-based content.
How about free to console?
Yeah, I was going to bring that up. Actually, I think a really exciting field, and certainly that some of the studios I've been working with are focusing more and more on sort of free-to-play PC, particularly for Steam titles, and as well as on console. Particularly on Sony, I think that there's a number of titles that are making actually significant amount of money, and those install bases continue to grow, particularly on PS4.
One issue that I'm seeing with those is those are not small budget production. To build a game that's going to perform well on console or on PC, multiply the numbers you're hearing from the mobile side by a reasonable factor before you can be comparable in terms of production value with the competition in that space.
On the production side, but yes, the marketing side is very different.
Completely agree with
that. For free-to-play console. Right. It's sort of the inverse of that, where in mobile, most of your dollars are going to be spent on marketing. That's not where the free-to-play console market is at the moment. Just having it there is marketing in and of itself at this point.
The issue is a venture capital issue of where the risk is, though. So if you go to a venture capitalist and say, I've got a game or a series of ideas or whatever, and there's this much dollars to get to the test to see if it's going to monetize well, that's one proposition, because your risk is front-end loaded. There's not a lot of money in development, and you get to see how it works pretty quickly. But if you're talking about building a free-to-play PC or console game, the production bet is much more significant, and you don't see any return, any informational return, until many, many millions of dollars more are spent. And that's a more difficult value proposition for the VCs to swallow, or any investor. Terrific. Thank you to the panel for a great conversation, and thank you.